So hopefully if you have watched the course in chronological order and you've gone through the technical analysis module, you followed the recommended roadmap, you've watched all of the lessons thus far in the trade plan module, then you should kind of, have a rough idea, sort of in the back of your mind, how to start thinking about how you want to trade in terms of, what is going to be in line with your trading personality, your psychology, what you think you sort of resonate with, whether that's more hands-off swing trading, whether that's a bit more active day trading, etc. But also importantly, what you can actually execute with your current lifestyle, whether you have a job, what time zone you live in, and all of these sorts of things, right? And if you're new to trading especially, or new to the style of trading, you would have seen through the technical analysis module that there can be quite a lot of variables to this strategy, and you can end up making it very, very complex, or obviously you can strip it back and make it quite simple. So obviously that can be quite overwhelming at the start, even if you are experienced with trading in general. So sort of my goal and idea with this lesson is to just give you that starting point, to give you that beginner trading system. Now, that doesn't technically mean, it's for beginners only. It's more just this is your beginning starting point, okay? So this plan is going to be reasonably simplified. Again, don't confuse simple with necessarily easy to execute in terms of, it's trading. It's never easy, but it can be very simple. And simple is the goal of this, just to get you executing mechanically. You're not worrying about trying to make money and pass funding challenges and quit your job at this stage. It's just have a simple mechanical plan that you can start to execute, that you can start to build patience and discipline with. And that, the main goal is you're collecting data that you now trust. So whether that's through both back testing and forward testing, you're collecting data on this plan. And then as you start to build that large sample size of trades, now you can start to make those tweaks and improvements to the plan and slowly make it sort of more and more advanced, or as advanced as you want to, in order to mold it into something that works most efficiently for you, and obviously to increase ideally the P&L that you were making over the long run. Okay, so that's basically the goal of this, is just to give you again, simplified, not necessarily easy, but simplified beginner trade plan to start with as your base, which then, you were going to continuously work with, and bit by bit, layer by layer, sort of variable by variable, you will build this up into something unique to you that is probably going to be a lot more advanced than what we're going to start with. Okay, so hopefully that makes sense, and let's go through that. So, if you could explain to someone what this plan is going to be in literally the most simplest form, is you are only trading, basically looking at two time frames, which is the M15 and the M1. Now you could obviously, insert your own time frames here. So instead of the M15 and the M1, you could do the 4 hour and the M15, for instance. Okay, but just for the purposes of this, and because the majority of you in the community will be executing this way, and it's obviously more similar in line to how I currently trade, let's just go with these time frames from now on. Okay. So again, the simplest way I could describe the system is you are only trading with the M15 trend. Okay, so if the M15 is bullish, you can only be looking for buys. If the M15 is bearish, you can only be looking for sells. Okay, and when I say the trend, I'm talking about the swing trend, right? So once you're trading in line with the M15 trend, the next thing you're going to be doing is you're basically going to be looking to trade from M15 points of interest, POIs, right? So M15 zones only. Okay, so it has to be with the M15 trend. You're only trading from M15 zones, and then you are using the M1 for your actual execution. Okay, so again, only trading with the M15 trend, you're waiting for price to come into that M15 zone. Once price is in that M15 zone, you drop down to the M1 and you look for your entry model. Okay, that's as simple as it can be. So we're going to go through this diagram in a lot more detail in a little short while, but I just quickly wanted to show you it just to kind of get your brain visually understanding what it is we're about to go through in text first, because it may help. So very, very crudely and quickly, super quick explanation would be, right, this is bullish, this swing trend here, right, this being the swing high, this being the swing low after the break of structure. We are going to be looking at only trading from those M15 zones, right, these blue zones, these two circles here, because we are only going to be looking for buys, as that's in line with the bullish M15 trend. As soon as price comes into here, we look for our M1 entry model, right? Again, as soon as price comes into here, we look for our M1 entry model, and that's it. That's as simple as it is. These are the entry models here, which we'll talk through again in a little bit, down the M1. And yeah, same for sells, right? We only look for sells when it's bearish. We wait for price to come into our POI, and then we hit one of these. Again, wait for price to come into our M15 POI, and then we hit one of these. And that's it. So in terms of mapping, i.e. how do you actually draw your technical analysis on your charts, remember we are only now looking at 2 timeframes whilst you are on this beginning system. Only the M15 and only the M1. So the M15 is essentially your higher time frame, and this is what you were using for your overall bias. So again, very simply, what you're going to be doing is mapping the current swing range that you are on. So like we just seen, right, you want to know where your current swing high is and where your current M15 swing low is, right? So that's your swing range. And then you want to draw on the premium and discount tool of that range, okay? So let's say the M15 is bullish, you've now found your swing high and your swing low, you draw on your premium and discount, and now you know that you want to be buying in the discount of that range, okay? Simple as that. And obviously map your valid supply and demand zone. So on the next slide, we're going to talk about a bit more about this, but that's essentially all you're looking to do in the M15. Know where your current swing high is, where your current swing low is, map on the premium discount, and then map on the valid demand zones in this case, right? If it's bullish, you're going to be looking at demand zones in the discount of that range. But again, we'll talk about this in a bit more depth. But that's literally as complicated as your analysis needs to be at this point. So hopefully, if you've gone through the course and you've done the recommended exercise, this should be very, very simple for you at this point. So the second main part to obviously this plan is the actual execution. So once prices entered into your relevant M15 zone, you then drop down to the M1, right? So obviously we've waited for the M15 mitigation. Then we're going to trade the M1 entry model, which we're about to take a look at, and then follow your management plan. Okay. So in terms of actual mapping, really you're only drawing your initial analysis on the M15. Then once price hits your M15 zone, then we drop down to the M1. We look for the entry model, which we're about to see, and you follow a very, very simple management plan. Cool. So this is kind of the actual trade plan here. So the first thing we're going to go through is how you select your higher time frame POI, i.e. the M15. Once we've done that, then we're going to look at the lower time frame execution. And obviously once you executed the trade or once you're triggered in, then you have to manage it. And then we'll talk about risk management as well. So like I said, we are only trading pro M15 trend. You're not looking at the 4 hour, you're not looking at the daily, you're not trading counter M15 trend. It's just if the M15 is bullish, you can only buy. If the M15 is now bearish, again, and we'll talk about the swing trend, you can only sell. Cool. Buy in the M15 discount and sell in the M15 premium. So all that simply means is we are trading zones that are well priced. Okay. So let's say the M15 is bullish. So that says, okay, so pro M15 trend, right? It's bullish. That means we can only buy. Okay. That's the first criteria. Second criteria, we can only buy in the M15 discount. So we've obviously drawn on the premium discount on our range, and we have to wait for price to come into those M15 demand zones in the bottom 50% of that range, right? And the exact opposite for selling. We're selling and it's bearish. We want to wait for price to pull all the way back up to the M15 premium, okay? So that way, we're basically trying to increase our strike rate as much as possible. Only trading pro trend and only trading well-priced zones. So what kind of zones are you going to use? We know they have to be on the M15, we know they have to be pro trend, and we know they have to be well priced. Well, we draw them on what we call pivot POI, so single candle POI. So rather than drawing it on, say, multiple candles, 2 or 3 candles, or drawing the whole range, it has to be a single candle POI. So that way, what you're basically doing is you're trying to refine your plan as much as possible and make the zone as accurate as possible, in order to just, again, boost your accuracy and boost your strike rate. Okay, so draw them on single candles, single M15 candles. Now, remember how we define what we call a strong supply and demand zone? It must either break some form of structure. The stronger the structure, the stronger the zone, right? So it just needs to either break swing structure, internal breaker structure, right? Which is essentially a chock. As long as it breaks some form of structure, it's a valid strong zone. Now, if you are trading zones that are well priced and with the trend, then generally they're pretty much always going to meet this criteria because it probably led to the previous breaker structure. Okay. So anyway, as long as it's either broken some form of structure and or it's flipped another zone, then it will be a valid M15 POI. And then the second criteria here, basically what this is saying is you do not have to worry at all about liquidity concepts in terms of picking your M15 zones, right? So it doesn't have to sweep liquidity and it doesn't have to have inducement, right? Inducement is just having liquidity in front of the zone, right? So again, to keep it very simple, we're only buying with the M15 trend. It has to be a well-priced zone, so buying in the discount or selling in the premium, and then you draw the zone on a single candle, right? So that gives you your higher time frame POI, and then only if that zone has either broken some form of structure and or flipped another zone, right? And we're not bothered of whether it's swept liquidity or has inducement. Okay, obviously you can start to pay attention to these things if you feel comfortable with them and whatever, but at this point, that is not part of the criteria, right? Because we're trying to keep it very, very simple. Cool. So if you basically can work your way through that criteria, right, and you tick all of those, right, that you need to have, now you literally sit in your hands and you set your alert on those zones, those M15 zones. And then once price hits those zones, now you can drop down to your lower time frame execution entry model. So what does that look like? Well, the first part of that is obviously we have to have that M15 mitigation. Price has to have tapped into that M15 zone in question, right? That M15 POI. Once it has done that, the next thing we want to see is an M1 liquidation. So essentially what that means is we want to see a sweep on the M1. We want to see some equal lows build, right, into a demand zone, or equal highs build into a supply zone, or just some form of liquidity sweep, at least visible on the M1 or higher. Now, that liquidation can happen within the M15 zone or just before it gets to it, right? But we want to see that M1 liquidity sweep because this really helps to boost the strike rate. Then we want to see the V-shape, right? We want to see that M1 move into the zone and then aggressively move out. And all that is simply showing us is that an overwhelming imbalance between supply and demand is happening. In other words, we kind of want to see that big money stepping into the market. We want to see, that's it. We want to see momentum coming out of that M15 zone. And that's essentially what we call, the V-shape. Once we have that, we then want to see a chalk. So I get this question a lot, but basically I cannot enter a trade no matter what until I have first seen that chalk on the time frame I'm entering on. So what does that mean? Well, in this case, if I'm going to be entering on the M1, right, from our M15 POI, I need to, at minimum, no matter what, at minimum, there first has to be an M1 chalk in the direction in which I want to trade. Okay, so imagine we're trading from that M15 demand zone. The M15 is bullish. We're buying from an M15 demand zone in the discount. Price has entered that M15 demand zone. We're now going through our lower time frame execution. Regardless of everything else you see here in the entry model, the first thing I'm waiting for at a minimum is to have that bullish M1 chalk. Because if that has not happened, then the M1 is still bearish and I'm not getting involved, okay? Cool. So once we have that, ideally, right, the M15's been mitigated. Ideally, we get that M1 liquidation. We get a nice V shape. The M1 has now had that bullish change of character, right? Again, if we're buying from the demand, so that's showing that M1 structure is now shifting in our favor. So now once we have that chalk, there should be at least one POI, but sometimes there'll be multiple POIs to choose from to enter on. So this is how we now pick which zone to choose to trade from. If there is a M1 flip, right, that caused the chalk, or sometimes it will happen after the chalk, only take the flip if it sweeps liquidity itself, right? So the flip will need to sweep liquidity. We'll talk about this in a little bit more detail if you're a bit confused on how that would look like, but that's when you would choose to take the flip. If there is a flip, but it doesn't sweep liquidity, then you will take the unmitigated extreme. Okay, what is the unmitigated extreme? All that simply is a zone that led to the chalk, right? That led to the M1 breakage structure that hasn't yet been tapped into, right? So sometimes you'll have the chalk and there might be the zone at the very bottom, right? There's a bullish chalk and then there'll be a flip in the middle. You only take the flip if it sweeps liquidity. If it doesn't sweep liquidity, you enter on the extreme. Simple as that, okay? And of course, sometimes there won't be a flip. There will just be a structure zone, right? Just the zone that breaks structure. Then it's very easy. You just take that extreme zone. Cool. Again, we'll go in this more detail anyway as we hop on the charts. And then obviously where you set your actual orders, and we're going to keep it very, very simple. And we're just going to set our entry limit on the distal of the M1 zone. So that simply just means you enter on the edge of the zone. So if it's demand zone, you enter on the top of it. If it's a supply zone, you enter on the bottom of it. Okay. And you always put your stop loss behind the zone no matter what. Okay. So what this should do in theory is kind of maximize the amount of trades you're getting triggered into. As you gain more experience and you gain more data, then you can start to look at either using fixed stop losses or entering on the EQ, right, to try and boost your risk reward. But at this point, we just want to get good at execution. We want to get in more trades. We want to build your experience. We want to build your confidence, etc., etc. So that's why we're going to keep it simple. And we're always going to enter on the top of the zone or the edge of the zone, the distal, and you're always going to put your stop loss behind. So this means your stop loss size may vary, okay? And it's the size of the zone that will determine that for you, right? So once you're in the trade, if you've been triggered in, we're going to keep this super, super simple. And no matter what you think, you are always going to take full profit. So 100% of your volume, you're going to bank that at 5R. Okay, that's it. So no partialing, no trailing stop losses. It is pure set and forget. So basically there is no active management. Once you set your entry order on your execution platform, right? So you set your entry on the edge of the zone, you set your stop loss behind, you will then put your full take profit order at 5R. And once you're triggered in, you do nothing. So that means there can only be two outcomes once you've been triggered into a trade. You either bank full 5R profit or you're stopped out for a full -1R loss. That's it. I'll talk about this a bit more towards the end, but the reason why we're doing this again is to just build experience, like build confidence, paying yourself, taking profits, because what can happen a lot of the time is people can get into good trades, but then they're always trying to swing it too far, they give too much profit back. Whereas actually 5R is very, very powerful. If you're entering, let's say with a 3 pip stop, you only need to catch 15 pips for 5R, 2 pip stop, 10 pips, etc., etc. Okay, I'll talk about this in a bit more depth in the middle in a bit, but this is super simple management. You can tweak this further on, but when you're starting out, this is all you're doing. Okay, cool. So risk management, maximum 3 total losses per day, right? No matter what. So you might win one, you might lose 2, and then you might win another one, right? So, but again, it's maximum 3 total losses. A win does not reset that. It's just 3 total losses per day. If you lose 3 trades, that's it, you're out. Come back the next day, okay? Basically, that rule is just to stop you going on tilt, and you're probably over trading anyway if you're taking anywhere near that. Risk 0.5% per trade. Again, you can risk more or less if you want, but it's just a general recommendation there. 2 pips stop loss minimum. Okay, in my opinion, shouldn't really be going much lower than that, especially when first starting out. But remember, you're setting your entry limit on the distal and your stop loss behind the zone. Okay, so that will determine how big your stop is, but never let it be less than 2 pips. So if that means you set your entry on the distal, and then when you put your stop loss just behind it, let's say maybe it's a small zone because it's a small candle and it shows it as a 1.5 pip stop loss. It doesn't matter, you have to add that extra half a pip, right? So it has to be 2 pip stop loss no matter what, okay? So the pairs I would recommend you trade, I would say definitely only euro dollar. Okay, I talk about this a lot, but it's, in my opinion, one of the easiest trades to master. It's the most liquid, so spreads are low. It's going to speed up your learning curve the quickest, right? Because obviously, the majority of us are actively trading. You can compare your markups and analysis to mine every day. A lot of the content's based around that as well. So euro dollar is all you need to focus on. Now, as you get a bit more comfortable with that, you may want to look at, or you may want to add in another pair. And then the second pair I would recommend, if you're at that stage, would be Aussie dollar. Okay, but literally, at least for the first month as well, just stick on one pair. There's more than enough to master, especially if you're doing your daily markups every day, you're forward testing, and you're also doing your back testing and building case studies. If you don't know what any of that is yet, testing module is coming up. We're going to talk all about all of that in there, but I know some of you at this point already know what that is. But if I could keep it simple for now, only look at one pair, only look at euro dollar. And if you feel you want to add in that second pair, my next recommendation would be Aussie dollar. Okay, so that's basically the plan written down in a nutshell. And then also sessions. So what those 2 times are there, so 7 till 10 a.m. And 12 to 3 p.m. So that's based on the London time zone. So I haven't written GMT because we have obviously daylight savings here, so that can shift in the summer months. So if you're ever not sure, if you don't live in the UK, or anywhere that has the same time zone as the UK, i.e. London, just put it into a time zone calculator. I'll try and remember to link one in the notes below the video, and just put in London time rather than GMT, because obviously, like I said, it shifts, okay? And if you compare your time to London time, you'll always know what those times are. So 7 till 10 a.m., that's essentially what, at least I call the London session. 7 a.m. is technically the Frankfurt Open, and then 8 a.m. is the London Open. But those 3 hours between 7 and 10, that's when I actively trade, and I just call it the London session, okay? Just to keep it nice and simple. That's when we know a lot of volumes going through the market, and typically that's when the highest probability trades set up when you were looking to obviously enter on the M1. And then 12 till 3 p.m., that's essentially the London and New York crossover. So that's basically, again, where you get that second wave of volume and you can get very good high probability setups. Okay, so there would be the 2 sessions I would concentrate on. If you can only trade one, that's absolutely fine. If you can trade both, that's cool. You can trade between 10 and 12 as well if you want to trade all day, but in my opinion, strike rate's a lot lower and you need to get away from the charts. You need a work-life balance. It's not healthy to be sitting there all day, and you're much more likely to get into taking lower probability positions. Cool, so that's that. So now let's get back to the annotated sort of trade plan, right? And we'll talk through this. Let's focus on the longs first. So like I was saying, right, first thing you want to do when you get to your chart is you want to be looking at the M15 and nothing else. And the first thing you want to know is, where is my current swing high and my current swing low? So in this case, right, this would be our swing high and this would be our swing low after we've had that break of structure. Okay, because this is the lowest point that took out this high after it was printed, right? So this is the swing low. Now we've had a sizable pullback. That's our swing high. Okay. So at that point, you would then draw on your premium and discount tool, right? So from the swing low to the swing high, and then that red line is the EQ. That's the 50% of the range, right? So remember the trade plan. What do we want to be doing? We want to be buying, we want to be trading pro M15 trend only. So if we know our swing high is up here and our swing low is here, we are bullish, which means we can only look for buys. Cool, that's step number one. Step number two, we can only buy in the discount. So when we draw this tool on, we can only look at M15 zones below this red line, okay? So in this case, I've already drawn them on, right? We have a discounted demand here, and then we have the discounted extreme here. So we know these two blue zones. Once price enters these zones, then we can drop down to the M1 and look for our entry model, right? Only once price is in an M15 discounted demand zone. That's it, nothing else. Cool. So once price enters that zone and our alert goes off, we then drop down to the M1, and these are pretty much kind of the only sort of three entry models that could occur, right? So one, what do we want to see? We want to see, again, assuming we already have the M15 mitigation, we want to see the M1 liquidation, right? So whether we have some nice equal lows would be the most ideal. We get that liquidation, right? Early buyers are stopped out, sucks in the breakout traders trying to short, etc., right? We've been to this liquidity module, but that's ideally what we want to see. We want to see pricing come into the M15 zone, and ideally we want to see that momentum come in, right? That V shape, right? So that's the next bit, the V shape, the aggressive in, aggressive out. We just want to see momentum come in our direction in which we want to trade, right? And then remember, one of the most important things is the chalk, right? We need to see at a bare minimum the M1 chalk. Because what you'll find as you kind of get a bit more advanced is we're not always going to get a nice liquidation, and we're not always going to get a nice perfect V shape, right? They're a little bit more subjective at times, right? We can try and make that mechanical as possible, but the most important thing is I will never take a position, right? 98% of the time, let's say for me personally, until I get that chalk on the time frame I'm looking to enter on, right? That needs to happen first. I need to be trading in line with the direction of the M1. Okay, so once we get that M1 chalk, right, we're at this point. Now at this point, once we get the chalk, again, okay, now I can look to start to enter. So where do I enter? Well, in this specific case, this first example, there is no flip because price just pushed straight up through, right? So it's just one straight movement, there was no reaction. So in this case, it's very easy, and we just take the extreme, okay? So if there is no flip, always enter on the extreme, right? That's nice and simple. Example number two, it's basically the exact same thing, so I won't describe it all, right? We have the liquidation, we have the mitigation, we have the overall V shape, we have the chalk, but it's after the chalk, right? That's a little bit different. Here, we did have a reaction, right? Price came into supply, it reacted, it failed to put in a lower low, which now means supply has failed to do its job. When price breaks and closes above the reaction, that's the failed reaction, right? Where supply then flips to demand, and we have the chalk. But we don't take the flip in this case because it did not sweep liquidity. Remember, the flip has to sweep liquidity. So why didn't it sweep liquidity? Well, it's because it's one straight movement up, it's one straight pullback, and it's one straight movement up. So that pullback here, it didn't sweep anything, right? There's no structural low here for it to sweep. So that's why we don't take it. And then in this case, you'll always take the extreme. Now, again, as you get more advanced, you may remove this rule and you may be happy to take the flip because sometimes these do play out a lot of times on euro dollar. But the point of this plan is to keep it sort of as high strike rate as possible. And that's why we have this in here. Okay, we'll talk about later how you can start to change these rules. But for now, just stick to this. And it just helps to keep things nice and simple so you don't get it confused. Okay, so again, quickly recap. If there's no flip, you always take the extreme. If there is a flip and an extreme, if the flip doesn't sweep liquidity, then we're going to take the extreme, right? Because in theory, if it hasn't swept, there's a higher chance that this is going to be a fake low used for inducement for here. And that's why we take the extreme. It's not always going to be the case. Sometimes this will still play out, but this is going to be, in theory, the higher strike rate. Okay. Third one and final one, again, exactly the same. Liquidation, mitigation, right? V-shaped reaction, M1 change of character. But we also have a flip here. And we have the extreme. And I just realized I've drawn this wrong. My bad, right? So that should be here. And then this would be the zone we would take, okay? We would take the flip because the difference between this and this is this flip swept liquidity, okay? So I'll leave that there so you can see how there would be two zones. Now, why did this sweep liquidity? And it's simply because this is a minor low, right? Because you can see rather than just one pullback and then you have the low, we have this movement, right? That movement up creates a low here. Price then sweeps that low, it grabs the liquidity below that low, right? And then we go up. So this would be a flip that sweeps liquidity, how I define it, right? And that would be what you can take. Again, not going to have 100% strike rate. Sometimes you can still fail and come from the extreme, but these are just the mechanical rules that you can follow just to remove, as much hesitation and doubt as possible. We just want to make it super strict, super clear, super systematic. Not for you to start to pass funding challenges with flying colors and blah, 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 blah. This is just about execution, data collection, and understanding your plan, okay? Cool. So, super quick summary. If the M15 is bullish, we know our current swing range, right? That means we can only be buying. Where can we buy? We can only buy in the discount below the EQ. We can only trade from M15 POIs, nowhere else. Price has to have mitigated an M15 POI. Once price mitigates an M15 POI, we then look for our entry model, okay? So ideally, we want to see that M1 liquidation. Obviously, the M15 is then being mitigated. We get the V-shaped reaction showing momentum coming in, and we need at least an M1 shock. If there is no flip, then we just enter on the extreme. If there is a flip, but it didn't sweep liquidity, we take the extreme. If there is a flip, but it did sweep liquidity, then we take the flip, okay? So a simpler way to remember it would be always take the extreme unless the flip sweeps. And that's it. If you can remember that, always take the extreme unless the flip sweeps. And that's the simplest way to basically just memorize all three of these, okay? And an exact opposite for shorting, right? Swing high, swing low, we're nowhere bearish, therefore we can only sell, and we can only sell in the premium, right, above the EQ. And you just do the exact same thing. And in management, no matter where you are, no matter what's going on, once you're in the trade, you just set your your target at 5R, okay? So in this case, right, that would be roughly there, right? That would be a 5R trade. So entry would always be on the edge of the zone, stop loss just behind. It has to be a minimum of 2 pips no matter what. So imagine you line this up, right? Just imagine this said 1.5 pips. You would go, okay, no, even though it's safe, I still have to have 2, and you'll drag it down, okay? And that's the rules I would recommend that you follow. Okay, cool. So yeah, in terms of kind of wanted to make another point about management, if you are obviously getting in down here, right at the bottom of the swing low and it's pro trend, and you get out for 5R, that's probably going to be around here. And a price, we know we're entering an extreme, has a decent chance of taking out that weak swing high. We know that, right? So you could be leaving a lot of profit on the table. So you're probably thinking, well, why am I only targeting 5R? That's a very, very good and logical question. But again, remember, the point of this trading plan is to get you executing, to try and bring in some consistency, to get that feeling of winning as well, to get that feeling of paying yourself. Because far too often, too many people get in here or whatever, and they're trying to swing for the fences, and they get too greedy and they give all their profit back. So that's the point of this. Now, once you get to the end of the month, or you collect, sufficient data size, right? Sample size, I'm trying to say there. Then you can go back and go, okay, well, out of all of my trades, what if I now target 8R? What then happens to my strike rate, my P&L, blah, blah, blah. Okay, what if I do 10R, et cetera, okay? Because, as you get more experience, then you can start to bring in more discretion, because obviously getting in along here is a lot different from getting along here. So here, it probably makes more sense to target 5R. Here, it makes a lot more sense to target 10R, things like that. But this just keeps it very simple, right? No matter where you are, 5R, in and out, okay? And the only other little sort of nuanced thing I want to add to this, because I probably get a few questions about this, is yes, we need to have the M15 mitigation, right? Ideally, we want to be trading these M1 entry models pretty much right within the zone, right? They're always going to be the highest probability, because ideally you're getting in near the swing rather than entering up here, right after the mitigation, because there's just an increased probability that price is going to pull down and then stop you out. So that's why it's always ideally with getting in kind of right here. However, sometimes that's not always going to happen, right? So let's say price comes in, it gives a chock, and then it doesn't quite pull back to your entry, right? It pulls back like this. You've got an entry down here, all right? And it doesn't tag you in and it continues up. Okay, cool. Can you enter this? It's up to you. You might not want to, but I would say yes. If you get that double confirmation entry and then it comes back in, I would enter that. This is going to where you have to use a little bit of discretion, but the point I'm trying to make is don't chase continuation. So if it keeps, if we get the mitigation, it pulls back, doesn't tag you in, again, and it just keeps going. With this beginner plan, don't start trying to take these advanced continuations up here, because it's a lot more advanced, it's a lot tougher to do. So I would say initially try and get in here, and then maybe if you get one more M1 sort of swing breaker structure, then try and look for that one. But if you kind of miss that one or doesn't pull back, leave it at that point would be my advice. Either wait for the next breaker structure, map out your new M15 swing range, and wait for price to come down again into your M15 zones, right? Or let this play out, right? Let it do whatever it wants, and then just wait for the next one to come in, okay? That's what I would say with that. The only caveat to that is, right, imagine that price comes into the M15 POI, right? let's say there's no entry model, or you take a trade and it's a loser, whatever. And then you go, okay, I'm going to set my alert on this level here, right? I'm not going to do anything until I have my M15 zone. That is correct. But then what happens if price doesn't tap into it, your alert doesn't go off, and then it does this, right? Imagine this orange line is the M15 price action. Well, yes, your alert hasn't gone off. It has not mitigated your M15 zone, but now we've had an M15 bullish chock. So what will that bullish chock do? It will create this. It will give you a new M15 zone. So yes, this is now valid for you to trade from. Why? Well, it's pro M15 trend, right? Because it's a demand zone and it's in the discount. So yes, this one where you had your alert has not been mitigated, but price has created you a new zone. So this would now be valid for you to trade from, okay? Does it mean that price might not fail and come down? That's fine, but both here and here are still valid, okay? So do be aware of that and do monitor price as best you can. Just gonna take a quick sip of water. Okay, cool. So I think that's kind of everything I wanted to cover in here. We will go through a lot more chart examples in following lesson, but for now, I just kind of really want to drive in the theory, kind of and keep it as simple as possible as that. So print this out, put it wherever you need to be, have it on your desk, look at it before every single session, during every single session, especially when you're about to place an order, and post session, when you're journaling, just put this on your bedroom wall, imprint it into your mind, okay? Yeah, so let's take a look at the next bit. So, like I've been saying kind of the whole way throughout this lesson so far, what is the outcome and, what should your goals be with this? Should it be to make 30R a month? No, right? This is not, like I've been saying, this is not, it's simple as that. This is not the goal. You're trying to pass funding challenges with this. Can you pass funding challenges with this? Of course. Should you get good results? Yes, as you gain experience and over a large sample size of trades, when you're thinking in terms of quarters, right? Not week to week, maybe not even month to month, you should be profitable with this by far, but you're not trying to make 30R a week, 30R a month. The goal with this is to build confidence and consistency in executing your approach. Your goal literally should be just having this plan and taking valid trades and trying not to miss any valid trades. When I say valid, I also mean there's high probability positions, and just get confidence doing that, right? And what this will also teach you is really to instill patience and discipline to execute this plan, because what you will find is that some weeks there just may not be that many trades, especially if price is very, very impulsive and there's a very, very strong high time frame trend. Okay, you may be waiting for those pro trend trades, but because you have to wait for a well priced zone, i.e. if it's bullish, you need to wait for price to pull all the way back to the M15 discount. If price is very, very impulsive, it may not pull back that deep, right? And you may have to sit in your hands for a little bit. So this will teach you that patience and discipline that will be so crucial as you start to develop through your journey, okay? So that's really, really a key part of this. Some trades or some sessions you might be active, some weeks you might be active. If you go an entire week without seeing a valid trade, that is more than okay. I know Instagram or whatever else would not make you believe that, but ignore all that shit. Delete social media off your phone, even ignore what's going on in Discord, and just trust the process of doing this for a minimum of a month and see it as your training, as your discipline and patience training. And I promise you, this will do wonders for your development long term. Okay. Another thing as well, like things like the management 5R, is to understand the power of what small consistent profits. And I put small there in quotation marks because 5R, believe me, some people would love to bank that in a month, let alone one position, which could probably play out in 20 minutes, if that. Right? So forget about these, 20, 30R and all that. 5R can literally change your life, okay? So get used to paying yourself. And then as you collect data, as you get experience, of course, then we can start to optimize it and start to look at those bigger positions. Okay? And a big part of this that, a lot of people don't, in my opinion, massively underweigh the importance of this is by having as mechanical and systematic, as a plan as you can, right? What this will mean is you'll be collecting data that you actually trust. Now, why do you trust it? Well, you trust it because, there's not really too many ifs, buts, or maybes. It should be almost as clear as this is definitely a trade and this is definitely not a trade. So then, it's almost like you can plug it into an algorithm. Obviously, there's going to be some element of discretion here and there, but you want to try and make that as systematic as possible. So then when you collect that data at the end of the month, ideally more than a month, right? A minimum 20 examples, right? And that's where back testing will come in. And again, if you don't know what anything is when I'm talking about testing, we have a whole module on this coming up. But essentially, you're going to be using this plan to collect data. When you then have that data that you trust, because it's right? It's not like, you know, sometimes if you have a bit of a wishy-washy plan, you could go, oh, I would have taken that one, or I wouldn't have taken that one, or I would have definitely held the trade that far, or, you know, all these things. That's when deep down subconsciously you don't really trust the data and what the data is telling you. Whereas with this, like I said, it should be crystal clear, not too many arguments around it. And then when you get to, you know, let's say after 30 trades, you can go, right, strike rate is X%, you know, my average expectancy is this, and therefore if I tweak this part of the plan, the data will then be this, right? And then when you have that data and you have those numbers, guess what happens when you're in the market? You are improving your plan over time with data and not emotions, right? Because you're not thinking, last time it was like this, I feel like I should do this. It's data. But when you're executing, when you increase your capital, or when you're going for high pressure things like funding, or whatever it is your goal is, guess what? That data is going to really help you to just, you know, with the psychological and emotional, you know, impact that trading has, right? If you can back up with data, of course, it's not just going to suddenly remove all of your emotions. But in my opinion, that's what at least has helped me the biggest amount. When you could just stare at the numbers, because the numbers do not lie, right? And another thing to remember about this is you only need around a 20% strike rate to break even if your winners are 5R. So that's why that management is so important, that you do not touch the trade when you're in it. It's either a -1R loss or a 5R loss. Please watch the Trading in Edge module if you have not done so, or remind yourself of it. And that will really help you to stick with that management, because what we are doing is we are trying to turn ourselves into the casino, right? So that way, random distribution then is not a big issue, right? Because we're just we're turning trading into a simple maths game, right? We're trying to turn it into that coin toss where we have an edge, right? So yeah, I don't want to rabbit on any too long about that, because you guys should be very familiar with this by now. And then this was just something I wanted to simply put in, because I see so many people tripping themselves up and getting in their own way because they do not understand, you know, the power of just something like 5%, right? When you have that capital, I know it's hard. So maybe when you don't have much capital, I'm not going to put figures out there because it's all relative, right? Everyone's different countries, different lifestyles, different upbringings, different beliefs around money, but just do whatever you have to do to understand the power of that. And this isn't even talking about month on month, compounding, etc., etc. This is just 5R, right? It literally can change your life. So try and drill these things into you. Forget about the money for now, and just realize, yes, this plan might not give you the best results compared to what you can make with it, but I just really want to drive this home. Just think about executing, think about the process, think about building data, and week by week, month by month, you are going to turn this into something that is extremely powerful based on data that works for you, that you truly understand, right? And also, if you try and jump into the more advanced plans, like looking at the 4 hour and the daily, trying to trade counter M15, trying to do all these different things. When do you wait for an M15 shot? When do you not wait for it? Like all these things, nail this first, and that will become a million times easier. I promise you. Okay, so if I could visualize what I was just saying, right? You might have seen this in a previous lesson in the Trading in Edge module, but your goal is to get this as close as possible to 0%, ideally 0%. Okay, so what is your performance discrepancy? Well, essentially what that is when you get to the end of the month or whatever you're journaling for, you want to compare the strategy's performance. So that's when you go through the data and you go, okay, here's all of the trades. If I had executed it like a robot, this is what the P&L should be, right? But then there's actually, your P&L, how you actually executed it, okay? And you want to get that to 0%, as in there should be no difference. So if you missed a trade, or maybe you took an invalid trade, right? That's going to give you a different result to what the actual strategy result is, right? Now you might outperform your strategy and you might underperform it, right? But your goal is to get it the same, to 0%. Hopefully that kind of makes sense as to why, because this is about executing your strict plan. Now, that's not about improving your plan. It's about you being the best trader you can be in terms of execution, because that will lead to the better results when you then start to tweak your plan, right? So hopefully that makes sense as to what I'm trying to get at there. So the journaling process and how you're going to do that, again, we're going to talk about this a lot more in depth in the journaling module, but I'm just going to quickly talk about it here. So day by day, right, you have your plan now. So now what you're doing is you're going to be looking at the live market, ideally looking at euro dollar, and you're going to create your markup for every session. So essentially what that means, again, we'll go about this in a bit more detail in the journaling module, but essentially at the end of the London session, you were going to obviously only be looking at the M15 and the M1, and you were going to draw on the swing structure for that session, and you're going to mark up the valid supply and demand zone. So remember, if it's bullish, you're only going to be drawing on demand zones. You're only going to be drawing the ones in the discount. You're only going to be drawing the ones from single candle POIs, right? And then you're going to mark up on the M1 if price mitigates it. Was there an M1 entry model? If there was, draw in the trade, record the result, and do that day by day by day. And that's how you're going to collect all of that data. But not only that, that's how you're going to start to build your experience without risking any capital, and seeing how price action develops. And that's how you're going to build confidence and experience, whilst then also doing back testing ideally as well. Okay, so you want to record basically all the trades you took, or at least the ones you saw and marked up, however you want to do it, and also any trades you missed afterwards, right? If at the end of the session you look back and you see, oh, this was actually valid, I didn't mark it up. So the idea of this is every single day you're basically collecting data for your plan. It's as simple as it is, but you want to be doing it every day, no matter what. So then at the weekly, you go over your daily markups and you look back through your charts, because you might have missed some trades. Sometimes that can happen. Did you miss any trades? Did you make any mistakes with execution? You're basically just double checking it, right? You're looking at your performance discrepancy against the strategy. And then at the month, this is kind of when you should have a bit more of a significant sample size. You, again, just doing a review of all of that. You want to see, this is when the strategy discrepancy figure is a bit more relevant, right? Because you've got hopefully a larger sample size, and you want to see your execution P&L versus the actual strategy P&L, right? And again, we want to get that as close to 0% difference as possible. Now, as you start to build up that larger sample size of data, right? So at minimum, it should be a month, but ideally we want to try and get it as big as possible. That's when you can then go through and look at what rules can you change to improve your profit expectancy of your plan. Now, we're going to talk about this in a lot more depth in the following lesson, because I don't want to kind of bog that lesson down with this now, but it'll be very simple things like, rather than entering on the distal, can you enter it on the EQ? Therefore, you can double your RR. But obviously, it's not just suddenly you double your results, because sometimes you might not get tagged into position and things like that, okay? But they're the sorts of simple variables at the start we're going to be looking at to see how you can improve your performance. Maybe it's simply, right, rather than targeting 5R, now I'm going to target 7R, right? But it's not until we get to at least the end of the month, but ideally just keep building that with as many trade examples as possible. That's when you'll be able to make those decisions, okay? So only make tweaks to your trade plan rules, like I was saying, after a minimum of 1 month's data, like an absolute minimum. And then that will help you to either enter more setups. Maybe you think you're not entering enough, or the plan's too rigid, or maybe it's too loose. Maybe you're entering too many trades and you're overtrading. Maybe you want to make it more strict. You have less setups. And obviously rules, then like I was saying, maximize your potential R, whether that's management, whether that's where you enter, etc., right? That's the goal of doing that, but we'll talk about that a lot more in a following lesson. So hopefully that should give you a very, very solid starting point to get going. But please just drill into your head kind of the outcomes that I was talking about this. It's not about making amazing R, whatever you want to define that as. It's about execution. It's about getting a strict plan. It's about really understanding that and collecting data that you trust to build that super solid foundation for you then to slowly, bit by bit, layer by layer, add and tweak variables to make it, quote unquote advanced, to really maximize your potential R. But that's tailored and suited to both your lifestyle and psychology. Okay, so we'll talk about this more in the following lessons and the following modules. We'll start to go through some more trading examples as well. But hopefully this will give you that solid starting point, honestly, to really, really change the trajectory of your trading and ultimately, without sounding cheesy, change your life.